All right, so we have a new ETF I want to talk about. This is WPAY or WPAY. This is going to be a equal weights of the Round Hill Weekly Pay ETF. So it's kind of an interesting concept. I wanted to talk about it. I wanted to get into it. I want to talk about my thoughts on it, obviously. First things first, if you get value out of the video, please like and subscribe. Check out the links below. So let's get right into it. The first thing I wanted to bring up here, just to get it out of the way, this ETF has paid dividends once. Actually, it's going to be paying again on the 23rd. So if we look at its just distributions here, it paid on the 17th, and it'll pay again on the 24th. So technically, the day of me putting this out, it's only paid once. If you're watching it after, it'll have paid more than that. So I'm not going to go into a lot of detail about the price returns because it's only paid one dividend. But if we do look at the price returns since it came out on September 4th. It's actually up about almost 7%, which is very good. That's very impressive. So that's the first thing. And honestly, it's the main thing that gets me excited about this ETF, because we have positive price returns on the share price, let alone with the dividend. Now, obviously, that's not guaranteed. It's only 3 weeks or whatever that is. So I'm not saying that it's a guarantee. I'm just saying so far we've seen positive price returns. Now, technically, the stock market is up nicely in that time. So obviously it could change. But this is something that with a lot of these ETFs, especially the ones that pay these really high dividends, is that the share price is going down, 20, 30, 40, 50% per year, some of them. And okay, you're getting a 50, 60% dividend, whatever the number is, but the share price is going down 50% a year. You're not really getting anywhere. So that's something that's very important to keep an eye on, is what is happening to the share price. So let's get right into it here. Inside Round Hill Weekly Pay is for diversified exposure across all single stock weekly pay ETFs designed for investors targeting weekly income and amplified performance. So if you take the average of the two dividends it's paid so far, it's right around 48, 49%, which is very good. That's very, very impressive. Seeks to track the performance of the Round Hill Weekly Pay Index. So it pays distributions weekly, every Wednesday, like I said. Diversified exposure. So the big question here, and this is something that I am a little bit critical of them for, is WPAY is rebalanced monthly to equal weight, ensuring consistent exposure to all of the weekly pay ETFs. So I think this is honestly a equal weight. I don't think it's a terrible design. Most ETFs like this are based on market cap. Both of them have their pros and cons. The one big critique I would have of them is I would cut out the bottom, 20 or 30% of funds based on performance. I don't know why they don't do this, because when you look at the S&P 500, for example, the top, 10% of the stocks in them are going to drive like 80, 90% of the returns. I don't know what the number is off the top of my head, but it's the vast majority of the returns. So something that I think is important is those bottom, 10, 20, 30%. You could argue the number is even higher, but I wouldn't cut out too many, because these are designed more for dividends and not for price returns. But I would cut them out because the performance is going to be better, right? The price returns will be better. The dividend probably will be even better as well. Now, maybe they're doing it this way because they want to try and pump the returns, the assets under management of some of the lower end ETFs. I can understand that. But as far as the sheer price return goes, and even higher dividend, I don't know why they wouldn't cut out the bottom performers. Now, technically, the ones that perform really bad probably will get delisted at some point. But when you look at like an ETF like ULTY, that's one that's performed absolutely terribly, but yet it still has a very high market cap. So that's why I would base it based on performance and not based on market cap, because, like, again, those are the yield max ETFs. But again, this one's still a similar idea, right? I I would cut out the bottom X percentage of performers, whatever number you want to pick, and I would do it based on performance. Obviously, that has to be, using a drip because these are mainly for dividends. So that's how I would do it. I know that's a little bit of a long tirade, but that's how I would do it. This isn't necessarily a terrible way of doing it, but that's how I would do it. 99 basis points is the expense ratio. So pretty much that is exactly what the other ones are. 77 million in assets under management. So that's actually pretty impressive for not even being out for a month to get that kind of assets under management. So if we look at the weightings here, obviously the weightings are different, but like they said, it's going to be rebalanced monthly. So when you look at it here, this is basically what it is. It actually looks like they just did do a rebalancing because the difference here is actually very small. When I looked at this a few days ago, it was definitely different than what it was here. So they must have already done that first rebalancing. Everything's between 6.36% and just over 7%. So that's a very small number. So basically the ones in here is the Apple one, the Nvidia one, the AMD one, the Tesla one, the Berkshire Hathaway one, the Netflix one, the Microsoft one, the Robinhood one, the Meta one, the Google one, the Amazon one, the Broadcom one, the Palantir one, the MicroStrategy one or Strategy one, and the Coinbase one. So that is the funds that are in here right now. Now, the big question here is if we go, let's just say hypothetically here, if we go like 5 years down the road, 10 years down the road, some of these funds, right, like some of these funds probably will be virtually non-existent or at the very least a lot smaller than they are right now. And there's going to be other ones that are really big. So that's my question is I don't really understand the let's just equally weight everything. That's something that I hope they change at some point. But again, I'm not the one running things. The other thing that I would point out here is I do own a small position here. And that position is number one, it's performed relatively well so far. So again, as long as it stays that way, I'm going to own it, right? And if I can get a 48% dividend with, let's just say a flat share price return, well, that's absolutely awesome. Even if you get like a negative 10%, on the share price every year, you're still getting a very good return. So the last thing to bring up here, again, this is the distribution schedule. The next, well, again, the one is already set for the 24th, but again, it is paying every Wednesday. The record date is going to be the day before, and the X date is also going to be the same. So the X dividend date and the record date is going to be the Tuesday. So if you want to get the dividend for that week, you're going to have to own the shares on the Monday or even sooner. So that is this ETF. Like I said, I think it does have quite a bit of potential, right? I mean, if it can not bleed as far as the share price goes, then I think it's going to do all right. And I think that is the big problem with the Yield Max funds and with a lot of these of the Roundhill funds is that bleeding share price return. A little bit is going to be okay. But when you're getting, some of these are down like 50, 60% in a year, like that is not sustainable. Like that's just not sustainable. Right? ULTY is the best example of this. So that's something that I think they need to fix. I think they would, I mean, it's only a matter of time. Like if Roundhill doesn't do it, if Yield Max doesn't do it, someone else is going to come in and do it. And I mean, other companies are coming up, right? I mean, in the Bitcoin space, we have Blocks that just came out. They're doing a pretty good job. You have the Harvest ones in Canada. They're doing a good job. So the thing that I really like about a lot of these is, well, about the space in general, is there's a lot of competition. And competition will only make it better for the average Joe because, I mean, a lot of people are terrible at picking investments. So there will be a lot of people that will pick the bad ones and lose money. But the people that are willing to do the due diligence and to put the research in, they're going to do really well because the more of these, and what does it say? Like the more of these that come out, well, the more competition it's going to produce. And eventually the big names are going to get into it. Like the big names are going to get into it. Like it's only a matter of time. Like if these continue to grow, it's only a matter of time until your BlackRocks, your State Streets, your Invescos get into this. Now, again, it might take 5-10 years, but if these can continue to grow, it's only a matter of time. right? It's really only a matter of time. And I think that these funds are driven entirely by retail. And that's another thing that I don't think a lot of people are talking about enough, especially the people that have been, the people that have, the financial advisors and, the traditional finance people, especially the people that have been in it for, a decade plus. I think a lot of these people are a little bit out of touch. I wouldn't say very out of touch, but a little bit out of touch, in that I don't think they understand the mindset of the modern investor, of the millennial and the Gen Z mindset. And I think that that's something that as the millennials, I mean, it's very close to them becoming, it's only a matter of time until the millennials are the majority of the people in running these things. I mean, eventually the Gen Xers, or is it Gen Z? What's the one after the millennials? I forget. But I mean, most of these funds are still being run by boomers, but within 10 years, they're all going to be retired, right? I mean, the oldest or the youngest boomer is like 60, 61, whatever. So give it 10 years, they're basically all going to be retired, and you give it maybe another 10, 15 years and virtually all of the next generation is going to be retired. So I think that, 10, 20 years down the line, Bitcoin's going to be millions, maybe tens of millions of dollars. And these kinds of funds that allow people to retire early and to get that freedom rather than having to wait till you're 65 or 70, whatever the modern number is, they're going to do really well. So I applaud the competition. I hope they improve these a little bit because, like I said, the big concerns are the big concern is the negative share price returns. Now, the problem with that is that to get that fixed, you're probably going to have to sacrifice you're going to have to sacrifice some of the upside when it comes to the dividend. That's inevitable because the way that they get these crazy high returns is to sacrifice share price returns. So that's just the way that it is. But I mean, you take a fund like this, I would take a fund where the share price will be flat over time with a dividend that is half this high, right? I mean, if you can get a 27, 28, 29, 30% dividend, like a 25, let's even be conservative, right? 25, even 20. I mean, if you can get a 20% return every year, that's double what the market is returning. That's even more than what the Nasdaq's returned over the last decade or two. So I think that's where I think the future of some of these funds are going to be, and that's why I'm so interested in blocks, in HBTE, in HBIX. Not that I'm all in, right? I'm diversifying within probably 15 funds, honestly, maybe even 20. So my goal when it comes to these is to diversify as much as I can, because some of these you are going to lose money on. Like it's inevitable you're going to lose money on some of them. But if you have 15 or 20 holdings, well, it's 5% of your allocation, so you're not going to get killed. So anyway, that's my thoughts on WPAY. I like I said, I do have this as a small position. I am buying it. I am planning on increasing it, but I'm not planning on making it being some massive position. If we're a year down the road and, the stock market is flat and this fund is still, like, the share prices are still flat, I'm going to become even happier. So that is the big caveat when it comes to this fund is what happens to the share price. The dividend's going to be fine, right? It's going to pay a crazy high dividend. The question is what happens with the share price. And we really aren't going to know with a lot of these funds until we see a big pullback in the stock market, right? That's what exposed a lot of these funds is, back in April when we had that, I don't know if you want to call it a crash, but it certainly was a large correction. A lot of these, the market was down, 15%, 20%. And a lot of these were down like 30, 40, 50%. And a lot of them haven't recovered. The ones that have, obviously their buys, they're looking good. But the ones that haven't are they really got exposed. So that's what I'm waiting for with a lot of these funds is what happens when we get, a 10, 15, 20% pullback in the market. That's when we're going to find out which ones are the ones you want to be buying and holding and the ones you don't want to be holding. So anyway, that's what I wanted to talk about today. If you liked the video, please like and subscribe. Check out those links below and stay tuned for more.